The big question is whether this year's exceptional dollar strength, driven by decoupling of the US growth from the rest of the world, will extend into 2019. We think the high-flying US dollar is set to cruise back to earth next year for several reasons. First, political gridlock deprives the US economy of more fiscal support. US growth boom is set to cool off and recouple with a moderate pace of expansion in the rest of the world. As US growth slows, the twin deficit problem will weigh on the US dollar in 2019. Second, weak spots seen this year could give way to China and Europe doing better in 2019, with the infrastructure spending already starting to show up in the Chinese data. Third, rate hikes in UK, Canada, Norway are likely to continue while other major central banks, such as Sweden, Australia, and Eurozone, are likely to join the policy normalizer club next year. The Fed is no longer the only game in town, and is probably closer to the finishing rather than the starting line compared with other major central banks. So we don't like the US dollar, but there is a problem. There are no clear currency alternatives to the dollar that really stand out in the near term. A meaningful US dollar decline will need to wait for US-China trade tension and European political risk, such as the budget standoff between Italy and EU and Brexit, to fade. Moving on to currency volatility, the appearance of calm in G10 FX land risks being deceptive in the face of late cycle risk. G10 currency volatility is low versus history and could play catch up to this year's rise in emerging market currency volatility as investors fret over recession and inflation risk in the context of maturing cycle. We feel that investors need to own G10 currency volatility into 2019. Higher market volatility tends to also benefit yen and gold, and owning some yen and gold could provide useful risk-off hedges to portfolio during late cycle investing.